Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap with me, Ryan Huang. We've got a couple of milestones to talk about. The S&P 500 rose as NVIDIA reached a major milestone, and investors are continuing to monitor the latest tariff updates from President Donald Trump. So the broad market index up 0.6%, closing at 6,263. We have the Nasdaq Composite hitting a new high, rising 0.9% to 20,611, and the Dow Jones Industrial Average higher by 0.5% to 44,458. Okay, looking at top movers, we've got NVIDIA adding 1.8%, the chip giant briefly hitting a market cap of $4 trillion, becoming the first company to do so. So that also provided a rising tide for other tech companies like Meta, Microsoft, and Alphabet. Let's check in now with Alex Morris. He is the CEO of FM Investments. Alex, how are you doing these days?
Oh man, it's getting tough out there, Ryan, but we're making it through.
All right, getting tough. Let's talk about what's been playing out in the markets. Despite all the uncertainty, despite all the tariff talk, markets are still pushing on. What do you make of it?
It seems odd to me that markets are pushing new highs. NVIDIA, as you said, is pushing all-time highs for any security in the U.S. ever. Yet we have tariff tantrum talk coming back. And the market seems to be shrugging off at least this volley of tariffs on copper, on Brazil, which seems to be more of a political attack than it is a trade war item. And the market doesn't seem to care, at least not yet. And I think that's where we have some watchful waiting is you can shrug this off just until it actually becomes policy and it goes into effect, and then the market has to deal with it. As we saw in April, big tariffs generally lead to big downtrends in the market.
Okay, how much should we be reading into the momentum? Because you've made a point in your report that it doesn't always equal optimism.
I think right now we just have some momentum in the market, from a few months of everything being kind of quiet. I think many folks assumed the deadline for tariffs would be extended. That sort of came through in comments from Scott Bessent, and then the president pulled them back. But the market seems to still be living on the taco trade for as much as that bothers the president. And it just seems that things are okay. We haven't gotten earnings season. It's just about to start. So we're in this sort of Goldilocks period where there's no bad news, at least not bad enough news the market believes, to take away the enthusiasm and some cash coming off the sidelines that sees all-time highs and wants to chase them.
Yeah, taco trade. So we are counting down to its August 1st. Talking about things to look forward to, we also have the implications, or at least the impact of the so-called Big Beautiful Bill. What are the implications to be watching out for?
I don't know that anyone really knows the answer to that question yet, and it's kind of curious. We have a suspicion that many folks are dropping the big beautiful bill into GPT and saying, "Hi, I live here. Tell me what's good and what's bad for me." And some of those folks are probably some legislators, quite frankly, legislators, given how quickly this happened and how big and diverse it is. So there's some good things in there for certain districts that we know about. There's probably a lot of things in there we haven't really absorbed the ramifications of yet. And that's what we're looking at. What are the changes to government structure? What are the changes to some of the spending that we believe will be highly inflationary? And which are those that are going to create just political instability when you start cutting government programs that are well loved?
Yeah, lots to unpack. So let's start maybe with the stuff that might support markets. So you've got tax cuts, I believe, and you've also got stuff that will help to provide some support for some sectors. What might be some of the beneficiaries on the front?
So certainly, the average taxpayer seems to be a beneficiary, and that's good for consumer spending, as spending is likely to stay high. And what we saw happen in the Middle East between Israel's 12-day war, as well as the U.S. response in Iran, showed that the defense sector is going to get a bump. Very few things do as well for the sector as a show of force, as successful as we just saw. But the only thing that might actually eclipse that is an agreement by Western forces to spend substantially more on defense. And we got that coming out of NATO talks a few weeks ago. So I think consumer spending looks good. And then ironically, defense looks good. And we like defense also as if we're wrong on this and things do start to go the other way, that defense will probably still hold up given the need for European countries to spend, generally speaking, on U.S. defense tech or partnerships.
Okay, so a lot of focus on where the consumer is leaning towards when it comes to spending. To what extent do you think that can be foreshadowed by the jobs reports we've been seeing? It's been quite a patchy spate of numbers.
We look at the jobs report perhaps from a slightly different angle than most. We were focusing on the unemployment number, which seems to be a result of folks leaving the market. And we started looking for when did that tend to last happen? And it seems this tends to happen when equity markets hit new highs and folks who were working until their stock balances were high enough that they thought they could live out a good chunk of their life on those amounts, they start to come out of it. So we were surprised to see unemployment come down. We think that makes sense on it, but there's nothing inherently wrong with the economy. There are still more job openings than there are jobs. If you're out there as an employer trying to hire a new employee, it's still hard to find talent, and it's still hard to just fill many of those positions. So although there are cracks in individual elements, and the immigration policy in the US has created more disparity in that space, it's just not bad enough for anyone to step in and do anything, certainly not the Fed. And the Fed is very much looking at $2 trillion of spending, saying, that inflationary concern is going to far outweigh any immediate job concern.
Yeah, how much do you think they're going to be taking on board the tariff deadline when they meet in July? How many rate cuts are you expecting for the rest of the year?
I think we're looking at one token cut at the end of the year. You and I have been talking about that number the whole year through, and we haven't deviated from that. We still think if Jay Powell had his choice at the beginning of the year, and again now, he would have affirmed the decision to just not do the press conferences and stop talking, just to see what would happen. And it's hard because any talk of tariffs is clearly political. He's made very clear he will not politicize his role as best he humanly can. But at the same token, he does have to look over the horizon and say, we now have spending fiscal policy that very clearly is inflationary by everyone's metric, and he has to take preventative measure for that. But I think nonetheless, the Fed does want to deliver some sort of cut, and at this point, if they delivered no cuts at all, that would be seen as tantamount to a hike, which I think would cause a much bigger ripple than a token cut of 50 basis points.
All right, Alex, let's unpack your investor playbook here and looking at the equity side of things. So you are advising not to try to buy the dip. And I think for many investors, it might be quite tempting to look at maybe the rally and think, hey, I want to get in. And then, hey, when the price pulls back a bit, it's time to jump on the bandwagon. But you're saying, that's not the best plan. Walk us through your thinking here.
So we've always liked diversification in your portfolio, and the 60-40 portfolio is having a great year. And in particular, if you were heavy U.S. shares, this was a great time to be heavier international shares. Fall of the dollar, plus just the rise of some European securities and Asian securities has generally been positive. So I think this time for investors, if you want to play an individual stock like NVIDIA or some of the tech names that have been the outsized winners in touching these new highs, right, that hasn't been as equally shared as it was in the last rally, then that might be fine. But practically, as we hit uncertainty, as we hit more political theater coming out of Washington, now isn't the time to be too greedy. Now's the time to be well diversified so you can live to fight through the next battle. Okay, so are we still on a 60-40 split when it comes to your portfolio? In general, yes. We like the 60-40. It's an easy way to play it. There's a lot of products that help you do that. We understand some folks who want to take a little more aggressive view will have a bit more equity exposure. We still think there's great opportunities in credit. And we think if rates do come down, if we're wrong, being exposed to the long end of the curve and longer in credits is going to be really positive and provide a meaningful return, likely when equities would start to stumble. Okay, in terms of diversification, where are you when it comes to gold? Because that has been on quite a tear. I think it's been outperforming equities for the past few years. Gold has seemed to defy logic and gravity, despite being heavy and dense. And, we were long into gold. We pulled back. I think now we're neutral to bullish on gold simply because we don't see any reason for it to stop. Last time the tariff tantrums came around, gold did very well. We think that makes sense. But we've cautioned investors not to buy gold because they see it as a hedge against inflation. Last bout of inflation, gold fell apart on you. But rather, it's an asset that seems to be more traditional Bitcoin for many. And as we've seen Bitcoin prices, which are up, there's some desire for this traditional scarce asset among turbulent times. Do you think it's the case with Bitcoin right now? Hitting new highs, breaking 112,000? Bitcoin is certainly shrugging off every bit of political news about tariffs and every other metric, which we think is more of a supply and demand issue as folks get into the product, as there are more easier ways for investors to access it than the traditional exchanges. But we don't see any underlying fundamental reason why Bitcoin should be the beneficiary of this over any other asset of that nature like gold.
Right.
But it seems to be easy to do. And I think a lot of folks have been underexposed to it and they want to get in.
All right, lots of stuff to think about as we head towards the rest of the year. And helping us out this morning has been Alex Morris. He is the CEO of FM Investments. Alex, always a pleasure chatting with you. Thank you so much for your time and insights.
Thank you.
All right, catch up with you again soon. Stay on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.